What if I told you there's a company that earns money every time someone swipes a card, without ever taking on any debt or lending a single dollar? This company processed over $3 trillion last quarter alone, and chances are you used its services today without even realizing it. Today, we're diving deep into Visa, one of the most powerful yet misunderstood businesses in the world. Founded in 1958, Visa runs a global payment network that processes credit, debit, and prepaid card transactions. Unlike banks, it doesn't issue cards or extend credit, but earns fees for transaction processing, including authorization, clearing, and settlement. These fees are typically a small percentage of each transaction. Visa also collects service fees from financial institutions based on card usage, and generates revenue from cross-border transactions involving different currencies. Visa currently offers a dividend yield of 0.67%, slightly below its 5-year average of 0.73%. The stock is trading at a price-per-earnings ratio of 29.2, compared to its 5-year average of 27.6, and well above the sector average of around 12. Based on valuation models, the expected fair value range for Visa shares is between $299 and $365, while the stock currently trades at around $351. This suggests that Visa is fairly valued at the moment, neither significantly overvalued nor undervalued. Visa currently pays an annual dividend of $2.36, distributed on a quarterly basis. The next dividend payment is scheduled for September 2nd, and to be eligible, investors must own the shares by August 11th at the latest. Visa's most recent dividend increase was 13.5%, compared to a 5-year average growth rate of 15.4% and a 10-year average of 17.7%. The company has a strong track record, having paid and increased its dividend every year for the past 16 consecutive years. Both the earnings payout ratio and free cash flow payout ratio remain consistently low year after year, despite Visa's aggressive dividend growth. It's no surprise then that both earnings per share and free cash flow per share have been steadily increasing over time. While 2020 was a weaker year due to COVID, the company has since returned to form, delivering EPS growth of around 15% annually. The sales growth chart also reflects this strength, showing consistent growth in the 10 to 11% range. Visa continues to buy back its own shares, which is something long-term investors highly value. And because total sales are also rising, the company is able to raise its dividend by approximately 15% annually without meaningfully increasing payout ratios. Both return on equity and return on invested capital are not only high, but trending even higher, consistently exceeding the 10% benchmark, which is very encouraging. Furthermore, operating margin and free cash flow margin have remained well above expectations over the past decade. Visa's management also handles debt extremely well, with the interest coverage ratio comfortably exceeding standard benchmarks for the past 10 years. Visa currently offers a starting dividend yield of 0.67%, and its most recent dividend increase was 13.5%. The company holds a AA- credit rating, which is considered very strong, and its dividend appears to be extremely safe. Based on current valuation, Visa seems to be fairly priced, especially for those with a long-term investment horizon. In the short term, it's clearly a growth stock, but over a 20-year period, with consistent dividend increases like these, investors who start buying now could receive a substantial yield on cost in the future. In my view, Visa still holds massive long-term potential. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Now let's go through the company's latest quarterly earnings report together. Net revenue, $10.2 billion, up 14% year over year. GAAP net income, $5.3 billion, up 8%. Non-GAAP EPS, $2.98, up a massive 23% year over year. This shows strong operating leverage, especially when earnings outpace revenue. Payments volume up 8%. Cross-border volume excluding intra-European Union up 11%. Total processed transactions up 10%. That's incredibly healthy growth for a company Visa's size. Cross-border in particular is crucial. It has higher fees, and its growth points to strong travel activity. In the United States, credit card usage saw 9% growth, while internationally, debit volume jumped by 11%. Visa's diversification across regions and product types helps smooth out macroeconomic risks. Total cards issued, 4.8 billion, up from 4.5 billion. Transactions, over 83 billion in the third quarter. These are massive numbers. The moat is real. Banks and fintech simply can't replicate Visa's scale overnight. Operating expenses rose 35% on a GAAP basis, but only 13% on a non-GAAP basis. Litigation, $615 million. Marketing and personnel expansion. Ongoing tech investment. Adjusted figures show cost discipline, and litigation provisions were one-offs. Free cash flow, $6.3 billion in the third quarter. Returned $6.0 billion to shareholders via buybacks and dividends. That's 95% of free cash flow returned. Visa is a cash cow, and it's rewarding shareholders generously. Data processing, $5.15 billion. Service revenue, $4.33 billion. International revenue, $3.63 billion. Client incentives, negative $3.97 billion. The negative incentives reflect discounts to big banks and partners, but overall gross margins remain extremely high. Fourth quarter revenue expected to grow in the high single to low double digits. Earnings per share growth forecast, high single digits to low teens. Nothing groundbreaking, but very consistent, especially in uncertain macro conditions. So, is Visa still a buy in 2025? Fundamentally, it's one of the most profitable, defensible business models on the planet. The only real threat is valuation, not execution. If you're looking for a high-quality compounder with global scale, high margins, and robust free cash flow, Visa deserves a spot on your watch list. UnitedHealth just posted a major revenue drop. Skyrocketing medical costs and Medicare spending are eating into profits. But is this just a short-term shock, or is it time to dump the stock for good? UnitedHealth, founded in 1974, is a leading healthcare and insurance company. The firm's United Healthcare division provides health insurance plans for individuals, employers, and government programs, earning money primarily from premiums and government contracts for administering Medicare and Medicaid. Optum offers healthcare services through Optum Health, care delivery and virtual care, Optum Insight, healthcare analytics and consulting, and Optum Rx, pharmacy benefit management, making money from service fees, pharmacy revenues, and clinical care. The company is currently trading with a 3.3% starting dividend yield, compared to its 5-year average of just 1.42%. The price-to-earnings ratio stands at 12.7, well below its 5-year average of 20.1, and also lower than the current sector average of around 15.6. The stock is trading near the bottom of its 52-week price range, and based on analyst expectations, the fair value is estimated between $382 and $467. Yet, the stock is already available around $267. All of this strongly suggests the company is significantly undervalued. The company currently pays an annual dividend of $8.84, distributed quarterly. The next dividend payment is scheduled for September 24th, and shareholders who own the stock before September 16th will be eligible to receive it. The most recent dividend increase was 5.2%, while over the past 5 years, the company has raised its dividend by an average of 14.6% annually. Over the last 10 years, the average annual increase was even higher at 19.3%. Due to the sudden rise in expenses, this year's increase was smaller than what investors have come to expect from the company. Still, this marks the 15th consecutive year of dividend increases, and impressively, UnitedHealth has paid a dividend for 32 straight years without a single cut. The earnings payout ratio has consistently remained below 30% in recent years. While it's expected to rise to around 42% over the next 12 months, this is still well below any concerning threshold. The same holds true for the free cash flow payout ratio. Looking at the earnings per share chart, a significant drop is expected over the next 12 months. Free cash flow per share has historically been more volatile, which isn't surprising and has been the case in previous years as well. The EPS growth chart shows an anticipated 25% decline over the coming year. However, sales have continued to grow, up 8% over the last 12 months, and EPS also rose by the same amount during that time. The company is actively buying back its own shares, which is generally a positive signal for long-term investors. The total sales chart also shows steady year-over-year growth. Both return on equity and return on invested capital have consistently exceeded expectations over the past decade, which is reassuring. Unfortunately, the same can't be said about operating margin or free cash flow margin, where performance has been less stable. On the bright side, net debt to EBITDA has remained at healthy levels over the past 10 years, and net debt to capital is in a clear downward trend, now also at healthy levels for the past few years. The interest coverage chart has taken a bit of a hit recently, but even here, the company isn't showing any major red flags at this point. The company is currently offering a 3.30% starting dividend yield. The most recent dividend increase was 5.2%, and with a strong A+ credit rating, the company appears financially solid. The dividend also seems secure, making the stock look significantly undervalued at its current price level. UnitedHealth Group just released their second quarter 2025 results, and it's clear they're trying to stabilize after a turbulent first half of the year. So what do the numbers actually tell us? Total revenue for Q2 hit $111.6 billion, a solid $12.8 billion increase year over year. But profits, not so strong. Operating earnings dropped to $5.2 billion, and adjusted EPS came in at $4.08, down from $6.80 a year earlier. Margins are under serious pressure, with the medical care ratio rising to 89.4%, up 430 basis points year over year. That means healthcare costs are eating a much bigger slice of the pie than expected. For the full year, UnitedHealthcare expects revenues between $344 and $345.5 billion. That's over 15% growth from last year. But margins remain tight, with expected operating earnings between $9.0 and $9.3 billion, translating to an operating margin of just 2.6% to 2.7%. The pressure is coming largely from their Medicare Advantage segment. Medical cost trends are rising far beyond what they priced for, 7.5% actual versus just over 5% expected, and they now expect that to accelerate to nearly 10% in 2026. Meanwhile, Optum, UnitedHealth's services arm, is expected to bring in $266 to $267.5 billion in revenue, with operating earnings around $12.6 billion. But even here, growth is mixed. Optum Health revenue actually declined by 7% year over year, mainly due to changes in legacy contracts and underperforming risk-based health plans. Operating margin dropped to just 2.5% from 7.1%. On the bright side, Optum Insight saw a 6% revenue increase, and Optum Rx grew 19%, thanks to new clients and higher prescription volumes. Now looking ahead, the company reinstated its full-year guidance. Revenue between $445.5 and $448 billion, an adjusted EPS of at least $16. The message is clear. UnitedHealth sees 2025 as a rebuilding year, with real earnings growth expected to return in 2026. Adjusted EPS strips out one-time impacts like intangible amortization and the fallout from the Change Healthcare cyber attack. That's how they get to the $16 figure. So, is UnitedHealth a wounded giant with a comeback story? Or are these cost pressures here to stay? Drop your thoughts in the comments and don't forget to like and subscribe for more deep dives like this. Is AT&T finally turning the corner, or are investors just falling for another dividend trap? With Q2 numbers out, the picture is getting clearer, and you might be surprised by what's actually driving growth. With roots tracing back to 1876, AT&T offers wireless phone services and broadband internet in the United States. The company primarily earns revenue by offering monthly wireless plans for mobile phones, charging for data and internet subscriptions, and selling or financing smartphones and devices. AT&T's large network supports fifth-generation 5G services and fiber optic internet, delivering fast and reliable connectivity to millions of customers. The company is currently available with a starting dividend yield of 3.94%, compared to a 5-year average of 6.58%. The price-to-earnings ratio now stands at 13.3, while the 5-year average was 8.3, and the sector average is currently 18.7. The expected fair value is estimated to be somewhere between $16 and $19, while the current share price is around $28. Based on these figures, the stock appears to be significantly overvalued at the moment. The company currently pays an annual dividend of $1.11, distributed on a quarterly basis. The next dividend payment is scheduled for August 1st, and to be eligible, shareholders must have owned the stock no later than July 10th. The company hasn't increased its dividend since 2022. In fact, it was cut that year. As a result, the average dividend growth over the past 5 years is minus 11.5%, and over the past 10 years it stands at minus 5%. The earnings payout ratio over the past 12 months was 51%, but it's been steadily rising since the 2022 dividend cut, even though the dividend itself hasn't been increased at all. The free cash flow payout ratio is also expected to start climbing again, based on projections for the next 12 months. Both earnings per share, EPS, and free cash flow per share have been declining consistently since 2021, which explains why the payout ratio keeps rising, despite no dividend hikes. This trend is clearly visible on the EPS chart. After the sharp drop in 2022, the decline seems to have slowed, but for long-term investors, even 2 consecutive years of EPS decline can be a strong reason to stay away from the stock. The company has been buying back more shares than it issues for the past 2 years, but the overall share count isn't decreasing nearly as fast as it should, especially when you look at the total sales chart, which shows declining revenue. That alone is a major red flag. Falling sales, combined with a stagnating dividend and weak earnings growth, are enough to make this stock unattractive for long-term investing. The return on equity (ROE) and return on invested capital (IC) charts also paint a disappointing picture, falling below what many would consider minimum acceptable levels. On a more positive note, the company is well above expectations when it comes to operating and free cash flow margins. There's no major concern in that area. In 2022, the company revised its debt policy, recognizing the need to focus more seriously on financial stability. As a result, debt levels are now under control, and the interest coverage chart currently shows performance at an acceptable level. The company is currently available with a starting dividend yield of around 4%. There has been no dividend increase since 2022, and it holds a BBB credit rating, which is considered strong. For now, the dividend appears safe, but the company needs to grow its revenue. Otherwise, another dividend cut could become likely within the next few years. Based on these factors, the stock currently appears to be significantly overvalued. Let's start with AT&T's main business goals for 2025. The company is focused on 3 key areas: growing its 5G and fiber customer base, with a focus on customer satisfaction and bundled services; boosting efficiency through AI integration, network modernization, and the retirement of legacy copper networks; smart capital allocation, including a $22 to $22.5 billion investment in 5G and fiber, and a $10 billion share repurchase program. In short, AT&T is tightening operations while still investing heavily in infrastructure and innovation. In Q2, AT&T reported 73.4 million postpaid phone subscribers with 401,000 net new additions. 9.8 million fiber subscribers with 243,000 new adds. Mobility service revenue growth of plus 3.5% year over year. Fiber revenue up 18.9% year over year. These numbers show a company steadily growing in high-value segments like fiber and wireless. Financially, AT&T posted $4.4 billion in free cash flow, plus 3.5% year-over-year growth in adjusted EBITDA. Adjusted EPS of $0.54, excluding DirecTV. Margins are holding up well, with EBITDA margins hovering around 38%, indicating solid operational efficiency. Mobility remains a growth engine. Service revenue grew by 3.5% year-over-year. EBITDA also up 3.2%. Postpaid phone churn stayed low at 0.87%. One interesting stat is the average revenue per user, $57.04, showing consistent customer value and stability in pricing power. Fiber continues to shine. Revenue grew 18.9% year-over-year. 243,000 new fiber subscribers, plus 203,000 adds for AT&T Internet Air. Convergence is key here. More fiber customers also use AT&T Mobility, reaching a 40.9% convergence rate. This integrated service model improves customer retention and ARPU, which climbed to $73.26. The business wireline segment is under pressure. Revenue down 9.3% year-over-year, EBITDA down 11.3%. However, AT&T added 398,000 FirstNet connections, showing strength in public safety and business wireless. This is clearly a legacy segment in transition, and losses are expected as copper lines phase out. AT&T is showing discipline here, paid $2.1 billion in dividends, spent $5.1 billion in capital investment, $1 billion in share repurchases this quarter alone. Despite $132 billion in total debt, net debt to EBITDA remains at a healthy 2.64 times. They're also sitting on $10.5 billion in cash, giving them room for flexibility. Here's what AT&T expects for full year 2025. Revenue growth, low single digits overall, 3% or more for mobility and mid to high teens for fiber. Adjusted EPS between $1.97 and $2.07. Free cash flow in the $16 billion range. Capital investment between $22 and $22.5 billion. These are realistic targets in line with current trends. AT&T isn't flashy. It's a mature, dividend-paying, infrastructure-focused company with clear strengths in mobility and fiber. While legacy wireline drags down results, the growth in fiber and wireless more than offsets that. If you're looking for stability, long-term cash flow, and a solid dividend, AT&T is worth a look. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.